Welcome back to Smart NYSE Investing. In the previous video, we covered how to start investing step by step. Now comes the real challenge. How do you actually decide which stock to buy? Because let's be honest, most beginners either buy what everyone is talking about or stare at the screen thinking, this looks like a good price, I guess. And that usually ends with, I should have done some more analysis. So today let's fix that with a simple, practical way to analyze any stock listed on the NYSE. Before anything else, ask, what does this company actually do? If you can't explain the business in one simple sentence, pause right there. For example, Coca-Cola sells beverages, Walmart sells pretty much everything. Simple businesses are easier to understand and easier to trust. Because if your investment sounds like, I think they do something with AI and cloud and something, you are not investing, you are guessing. Next, look at revenue, which is basically the company's sales. Ask yourself, is revenue growing over time or is it stuck? Like your gym membership. A growing company usually means more customers, more demand, better long term potential, no growth. That's a red flag. Now, here's where many beginners get confused. A company can have huge sales and still make no money. So, always check net profit, profit margins, because at the end of the day, revenue is vanity. Profit is a reality. If a company sells a lot but keeps nothing, that's not a business, that's charity. Now, let's talk about debt. Some debt is normal, too much debt, that's a problem. Look at how much the company owes, how much cash it has. Strong companies survive tough times, weak companies struggle when things go wrong. And in the market, things always go wrong at some point. Don't worry, we are not going into advanced finance here, just keep it simple. PE ratio tells you if a stock is expensive. High PE expensive, low PE relatively cheaper. ROE return on equity shows how efficiently the company uses money. Higher is usually better. Debt to equity measures financial risk, lower is safer. You don't need 20 ratios, even understanding these 2-3 makes you ahead of most beginners. A good company in a bad industry can still struggle. For example, ExxonMobil benefits when energy demand rises. Lockheed Martin's benefits from defense spending. Always ask, is this industry growing or declining slowly? Because you don't want to invest in something that's going out of trend. Here's the most important part. The stock market does not reward the past, it rewards the future. Ask yourself, will this company still be relevant in next 5 to 10 years? Is demand increasing or decreasing? Because the market is always asking what happens next, not what happened last year. Before buying any stock, just run through this checklist. 1. Do I understand the business? Second, is revenue growing? Third, is the company profitable? Fourth, is the balance sheet strong? Fifth, are valuation reasonable? Sixth, is the industry growing? Seventh, what does the future look like? If you can answer these, you are already investing smarter than most people. This content is for educational purposes only. It is not financial advice or a recommendation to buy or sell any stock. Markets involve risk, and you should always do your own research or consult a financial advisor before investing. In fact, the simpler you process, the more consistent your decision will be. In the next video, we will take a real company listed on the New York Stock Exchange and analyze it step by step so you can see this process in action.